Chavez for NYSE TV, and joining me today is Sal Gianetti. He is a senior partner at PennantPark. We're back on the 4th episode in our series of private credit investing. Welcome to the New York Stock Exchange, Sal.
Good morning. Thanks very much for having me.
So we're going to talk more about middle market. Tell me exactly what this is.
Broadly speaking, the middle market, as we define it in the United States, is roughly companies of $10 million in sales up to $1 billion. Roughly 200,000 companies in the United States fit that category, representing $10 trillion of GDP. It's roughly 1/3 of all the companies in the United States. At PennantPark, we focus on middle market companies, and we define the core middle market for our target lending vehicles of $10 million to $50 million.
Can you tell me about your view in the middle market lending space today and the amount of capital that's flowing into it?
You bring up a great point, because there's been some very interesting factors affecting middle market lending over the last 15 years. Banks have continued to exit that market where they used to be dominant. Firms like PennantPark have increasingly stepped up to fill the void. In recent years, many firms have raised larger and larger credit funds. Those companies tend to lend money not to the core middle market that we focus on, but to larger and larger companies, really competing against what were the bank market and syndicated loan market that large companies tend to focus on.
Now, you mentioned that you believe the best opportunities for PennantPark are in the core middle market. What do you mean by that?
You know, we really love our market. As I mentioned, banks have exited the market. Funds that had served that market continue to grow. That really leaves less competition for us as we focus on the core middle market. We tend to get higher yields, lower loan to value, lower leverage, additional protections. We really have time to do all of our work and our due diligence. In addition, one of the things that's been beneficial to our returns is that we are able to negotiate equity co-invests, which potentially can really enhance our returns over the long term.
What is your view when it comes to investing in smaller mid-sized companies versus larger corporations?
You know, our clients and borrowers are really small and mid-sized companies that are well-established, strong free cash flows. Some people have a view that smaller companies are more risky, but as I mentioned before, our leverage tends to be lower, our loan to value tends to be less. When you really dig into the data and you look at the recovery rates and returns over time, we feel there's a very compelling case that our corporate borrower set outperforms other segments of the market.
Well, thank you so much for all of this insight, Sal. I really appreciate you joining me today.
Trinity, thank you very much for having me.
Absolutely.